Okay, hi everyone. This is going to be the lecture for the PowerPoint video for Chapter 6. We're going to be looking at interpreting sales revenue, accounts receivable, and cash. Right, so basically this chapter we're going to do a little bit of a zoom in on the income statement. We'll look at different ways that you can record revenue. We'll look at like dealing in person, services, goods, as well as at a distance, how that would affect revenue recognition. Then we'll look a little bit at net sales revenue. So we've seen that a little bit in other chapters, like in equations and things like that, but we'll really define it and give it some teeth here. Then we'll move over to the balance sheet. We'll look at accounts receivable on there and different ways how you can classify it. Then we'll spend a good bit on figuring out how to calculate bad debt expense for accounts receivable. Finally, we'll round out the chapter. We'll talk a little bit about reporting and safeguarding cash, different like controls you can have over cash, including preparation of a bank statement or a bank reconciliation. So first off, when we're looking at the income statement, right, let's talk about net sales revenue. So generally, when we've talked about revenue recognition so far under accrual accounting, GAAP, we said that you recognize or credit revenue whenever it's earned, right? Now, for the providers of services, generally you're going to recognize revenue whenever you provide the services, right? Like a painting company paints the house, credit revenue. For sellers of goods, so far, we've talked about providing those goods in person, right? We have a pizza shop, somebody comes in, they buy a pizza, here you go, credit revenue. However, right, how does this analysis change for the seller of goods when the parties are dealing at a distance, right? In these cases, when do we recognize the revenue? When we ship the item? When the seller receives the item, when we sell it, right? How does this all work? Well, here's the idea, right? Under GAAP, revenue is going to be recognized, whether it's in person or at a distance, when title and risk of ownership transfers to the buyer. Right? Now, when they say the word title, they mean legal title, like the title to your car. So with that, right, normally in person, title is going to transfer, here's the pizza, there you go. However, right, when we're at a distance, what will happen is we will have a sales contract, right? So imagine, I don't know, a simple way to explain this is maybe as if you were like selling something on eBay. It's a little bit different for businesses, but here's the idea, right? You list an item on eBay, somebody purchases it. How do you recognize the revenue? Right. Well, at the time of purchase, if the person clicked like buy it now or buy, title hasn't changed, right? You haven't given them the goods. So that's not what controls. Instead, what would happen is the business and the individual who was buying the good, they would enter into a sales contract. For example, I live in Pennsylvania, you live in California. I agree to sell to you widgets, right? Now, in this sales contract, among other provisions, there will be an area about, selling terms, right? And basically, these selling terms, there's one of two ways we can describe them, and they're called free on board terms. There's FOB shipping point, and there's FOB destination. And what these terms control from a legal sense is when title transfers. So, FOB shipping point, right? If I was selling something on eBay, I would recognize the revenue whenever I ship the goods, right? I go to the post office, put it in the box, it's shipped, credit revenue. I recognize it. In distinction, the FOB destination, if the terms of the sales contract were that and I was selling something on eBay, I would only recognize the revenue, credit the revenue, when the buyer actually received the goods, right? So I shipped it and then they drop it off at his doorstep or he signs for it, right? At that point in time, that's when I ship the goods. So Basically, in accounting under GAAP, we recognize revenue when we earn it. When we're selling goods, we're going to earn it, when we give it to them in title transfers. When we're at a distance, title transfers based on the FOB terms. FOB shipping point, when we ship the thing, we recognize revenue. FOB destination, it could state that instead in the contract, when we ship it plus it's delivered, we recognize the revenue. It also controls these FOB terms, risk of loss. So like when title transfers, that's when risk of loss transfers. So for example, if I was shipping, a watch or something, right? And it was FOB shipping point. Once I ship it, bam, credit revenue, it's now yours. If the thing gets destroyed by a bolt of lightning on the way to you after I ship it, risk of loss is passed to you. In distinction, FOB destination, if I ship it, right, I'm the seller, I ship it, if it gets hit by a bolt of lightning or lost or something like that, I bear the risk of loss until it reaches you. Okay, so we did a little bit of an expansion there on the revenue recognition. We looked at FOB shipping point and FOB destination. If we're talking about revenues and expenses, let's talk about sales, right? And specifically, net sales. So when we say the word net in accounting, it really means we're offsetting one item by another, right? So like net income is your revenues minus your expenses. It's kind of like a fishing net, right? If you scoop that thing in the water and you pull it out and you just have what's left over, right? It's kind of like that with net income, right? You scoop it in and what's left over, what you netted, was the fish, was the net income. Now, in the same way, right, that we do net income, we also want to report net sales. And essentially what this is doing is just a more accurate way of presenting our sales. And in this dynamic, right, we're going to have our gross sales, right, our total sales revenue. So the word gross in accounting or tax, it just means like total, right? It's the gross amount. It's different than normal language, right? Like normal language, if you heard the word gross, you'd think like yucky or something. In accounting, it just means total. So gross is total sales. You're going to back out from that, subtract out certain items, this CARD acronym. That's going to get you to your net sales, right? So like revenues minus expenses equals net income. Gross sales minus this CARD acronym equals net sales. And this is just showing you down here, right? 1,500 minus these guys gets you the net, right? And the CARD acronym is going to stand for credit card fees, returns and allowances, and then sales discounts. And we'll talk about what each of those means, right? But when you look at an income statement, the first line item you're going to see on there is net sales. So they don't put gross and then list out all these subtractions. They kind of do it, get it to the net amount, and then put it on here. So like if not stated explicitly here, implicit to this idea, there's already subtractions there. It's your gross sales minus that card is your first line item. Okay, so let's talk about what this CARD acronym means, right? Like why we're subtracting it out. The first one here is credit card fees, right? So if you have a business and you're selling goods and items, you may consider, offering a credit card to your customers, right? You could check out when you buy the pizza, you can give me cash or you can give me credit card, right? You can pay with either of those two. Now there's good and bad with each of these components, right? As a business owner, the good is having a credit card opens the door for more people, right? Because people tend to carry credit cards more than they do cash. Also, it's more efficient, right? If I have like a line out the door of people wanting to buy my goods, I can get them through with a credit card a lot quicker than handing out cash and things like that, right? And counting out the pennies. It's just more efficient. The downside of a credit card, and this is why some businesses are cash only because the owners really don't like this, is every time somebody comes in and they use a credit card, you got to give a percentage of that sale to the credit card company, like Visa, MasterCard, and it's like 2 or 3%. Right? So this idea, right, when we're talking about net sales, if we had 100,000 in sales, the first one of the items in the card acronym that we would have to back out are our credit card fees, right? So if we had 100 in sales, we'd have to back out the 3% to the credit card company. 97 is our net sale. So this guy 3 here, that would be the C, the credit card fees. And it could be 2%, 3%. It's all a function of what you negotiate with the company. But all day, every day, if you go and you talk to a business owner and you say, would you prefer that your customers pay in cash or credit card? All day, every day, they're going to take cash over it, right? And that's why some businesses, they actually have like a de minimis threshold below which you have to use cash, right? Because like for example, if you ever go to a gas station, it says like $5 or $10 minimum to use credit card. They don't want to have to pay those fees for those little small transactions. Likewise, there's been like legislation and issues. Some businesses try to put those fees onto the customers, right? So maybe you buy an item, and it'll be $1 plus 7% sales tax plus 3% credit card fee. They'll try to shift the fee over to you. So just be aware of that. There are some dynamics when you go to places, right? Credit card versus cash. Next time you're at dinner or something, you can think about these things when you're checking out. Should I pay cash? Should I pay credit? Right? It's the same with like waitresses, right? All day, every day, a waitress is going to prefer cash over credit card. That's for a different reason, not necessarily that she's paying the fees, but waitresses, they have to claim those tips. That's taxable income, regardless if it's cash or credit card. But they like cash because it's easier, if you wanted to hide it, aka illegal, when you report your income. But again, businesses, waiters, waitresses, cash is the preference. All right, sales returns and allowances, right? This is the next thing. We sell an item and somebody comes in and they return, right? So it's not appropriate to report our gross sales and then not consider the fact that people returned it. So that's the idea here. Right, we sell 10 watches for $100, report gross sales of $1,000. One person returns it. Hey, we got to back out our allowance for returns. In that case, we're going to have 1,000 gross minus 100 returns, 900 net sales. Now, the idea with this, one thing you have to be cognizant of when we look at the problems, the first one in this CARD acronym that you want to apply is the return. So even though it is CARD, I just made this acronym up to help you remember it. A comes first, AR comes first, the returns and allowances when you start applying these rules. So here's a journal entry just showing what it might look like for a business if they have to pay that credit card fee. And then here's kind of a how you get from your gross sales, back out that card, gets you to your net sales, okay? All right, the last part of this CARD acronym, right, when we do our gross sales minus the card gets us our net sales, are discounts, right? So here's the idea with it. First off, these apply only to sales on account. Right, somebody comes in, we give them the goods and services, they're going to pay us later. We have an account receivable. In these cases, right, one of the things that we'll do is we'll give the person a sales invoice, and on there will be credit terms, right? And among other things, the credit terms are going to offer a sales discount, right? And the idea with the sales discount is that it's going to encourage early payment. So by way of an example and through analogy, right? If you buy a house and you own your house outright, periodically, once a year, you will get your property tax bill, right? Or you may see a same phenomenon with other bills. And let's just say it's $1,000, right? On that bill, it will say something like, if you pay in the next month, you only owe $900. If you pay in 30 days to 60 days, you owe 1,000, and if you owe past 60 days, you owe 1,100. Right, so as you as the property owner, you're going to want to pay that as soon as possible. Take them up on that $900, right? It's the same thing when companies make sales on account. They will dictate and control at the time of sale, put in there credit terms that encourage people to pay early, right? And the idea with this, right, as a classic example is, let's say we make a sale on account for $1,000. That sale is subject to the credit terms of 210 net 30. And what this tells our buyer, right, the guy we give the goods to and he's going to pay us later, we tell him from these terms, we're saying, hey, if you pay us in the next 10 days, the cash, right, we want to collect this receivable, we'll give you a 2% discount on what you owe us, $1,000, right? It's like a coupon. So you'll only have to pay us $980, right? 2% or $20 is a discount. Otherwise, you don't take us up on this, right? You don't pay in the next 10 days. The net amount of basically whatever you have remaining outstanding after we consider returns is due in 30 days. So again, in the same way with property taxes, where you want to pay early to take them up on that discount, when you sell items on account, you can encourage your buyers to pay you early that account receivable through these credit terms. Right, so here's an example of an invoice. Maybe we sold something for $274. We give this, the goods to the person, and we give them this document, right? That document says 210 net 30. What it tells the person is, right, if you pay in 10 days from now, we'll give you a 2% discount. Otherwise, the rest is due within 30 days. And if they were to take us up on this discount, right, this is the journal entry we would do here, right? They pay us the cash, some of it's a discount, we flip out the account receivable. Right, so that was the CARD acronym, right? You get your gross sales minus the card, your credit card fees, your returns, and your discounts. That will get you your net sales. And the last point I kind of want to emphasize with this 210 net 30, that's a classic example, but it could be anything, right? It could be 5, 6, net 40, 1, 2, net 100. Right, you should know this as an example, but on the exam or something like that, I could change it to different numbers. So memorizing this is not enough. You have to understand what each component here means. All right, the next item here, right, we're going to talk a little bit about how do we deal with revenue recognition when we have a mixed good, right, and service, right? So for example, AT&T. Maybe they sell a phone as well as a phone plan. Or Jaguar, right, the car company. Maybe they sell a car that has a care plan and it's the good. So there's kind of like a 2-in-1 here, right? It's like the shampoo and conditioner in one bottle. We have the good and the service in one sale. A phone plan plus the telephone plan. A car plus a care package. How do we deal with revenue recognition in these cases, right? And one of the things with these cars, I recently saw some news article, the fancy cars, the BMWs of the world, they are trying to do stuff in the future where you'll buy the car and then you'll have to pay to use the features in it periodically, right? So maybe you spend 50 grand on your BMW, but then to use the heated seats on the inside, you got to pay like $10 a month. Right, so that's no fun. A lot of people weren't happy about that. I think it's one thing if it's like premium things like Sirius Radio or OnStar, right, Once Upon a Time. It's like one thing if you can't access those. It would be another really annoying thing if it's stuff like heated seats or you imagine how far they could take it, right? Like your touch screen on there. If you want to be able to use that, you got to pay us money. Cars, any company is always, every company has their business model, right? In any event, what we would do here, if we used an example of maybe an iPad, and with that iPad, Apple has to provide future software upgrades. First thing you got to do is break out the sale between the good and the service, right? The iPad and the upgrades. Second thing, look at the price. Maybe this iPad's $500. And then you have to allocate from that $500, how much of this sale represents the iPad itself, the physical good, $450, versus how much of it represents the service that we're providing the customer, right? Those future upgrades. So maybe it's $50. Once you break it out, you recognize the revenue accordingly. You know, the iPad, when you sell it, here's the good, here's the pizza, there you go. And then the future software updates every year as you provide the service. Year one, revenue. Year one, revenue. You have to break it out, recognize it, you know, to when you earn it based on the type of revenue, goods or services. Okay, next thing, we're going to move on from the income statement, talk a little bit about accounts receivable. So we've talked about them, you know, so far. We talked a little bit about 210 net 30. Those items would be used to help encourage payment on accounts receivable. But how does it work, right, if we want to classify them? And what do we do for this thing called bad debt expense? All right, so first thing here with accounts receivable, a variety of different ways you can describe them. And these are not mutually exclusive categories. In other words, you can have an account receivable that's a current trade receivable. So like a current, non-trade, note receivable. You know, the division is in between each item, but they're not overall mutually exclusive. In any event, right, an account receivable is when there's a sale on an open account. In distinction, a note receivable is when there's a formal writing and a contract, and it also includes interest on the principal. By way of an example, right, if there was a $1,000 account receivable, you would pay back the person $1,000. If there was a $1,000 note receivable, you would pay back the person $1,000 plus maybe $100 of interest. So similar in theory, what they are, they're assets. This guy's a little bit less formal and there's no interest. This guy's more formal, it's on formal writing, and there is interest. Second way you can describe it is if it's a trade receivable or a non-trade receivable. So a trade receivable would just be coming from the ordinary course of business, right? We sell pizza, we sell watches on account. Hey, it's a trade. It's our trade or business. A non-trade receivable would be more like one-off items. It's definitely more the exception than the general rule. So maybe you have a sale where there's money that somebody owes you that's not from the ordinary course of business. And then finally here, the third way you can kind of slice and dice this is whether it's a current or non-current receivable. Do we expect to collect this receivable in the next year? If yes, it's a current receivable. If no, it's a non-current receivable. All right, next guy here, let's look at accounting for bad debts. Right, so first things first, we're talking about accounts receivable. So when a company sells on account, they do this journal entry, right? Debit account receivable, credit revenue. You can think of this as like step 0, right? Because moving forward, we're going to talk about bad debt expense, which is step 1 and step 2. But that presupposes that we made an account on sale or a sale on account. So just, as a starting point, that's the journal entry. Think of it like step 0. It's an account receivable. We give them the goods. They're going to pay us later. There's no interest on it. All right, but here's the deal though. Right? Not everybody pays the money they owe. So if you think of like a bookie, right? Like a gambler, a bookie, usually in like the mafia movies or whatever, media they portray this in, the bookie has like a henchman or something, right? And he sends this guy out. You have a gambler who says, I'll bet $100,000 on the game. The gambler loses, and then the bookie can't find him. So he has to like send his henchman out to get him to collect this money, right? Like beat him up or something. I don't know how this like underground criminal world works. But in any event, right? We don't do that in accounting, right? We're a business. You can't send a henchman out to beat somebody up. That's crazy. But the same principle of people not paying money holds true in business, right? We may make a sale on account that the person's not going to pay us, right? And this idea of not being able to collect a sale on account because they won't pay us is known as a bad debt, right? It's a debt somebody owes us, but it's a bad debt because they aren't going to pay us. So we take an expense for that, a bad debt expense. You write it off, right? You take a deduction. When they say write off, they mean take a deduction or expense. Now, how you actually go about doing this, right? If that's the framework, sell on account, people aren't going to pay us, how do you account for that, right? So a simple kind of intuitive way, much like the cash basis, right, is if I said to you, how would you know somebody's not going to pay you? Well, you'd have to wait until they don't pay you, right? You could tick, 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 time passes, they're not going to pay us, take the expense, right? Debit bad debt expense, credit account receivable. This idea is called the direct write-off method. We basically wait, we sit around until we know they aren't going to pay us, then we take the expense. However, much like the cash basis of accounting, this is not GAAP, right? You don't use the direct write-off method. Instead, right, GAAP is generally going to follow this thing called the allowance method, right? And in the allowance method, we have step 1 and step 2. Right? There's kind of step 0 over here where we make the sale on account. But essentially that's what happens is, what's going on here is step 0, debit account receivable, credit revenue. Now we're at a later point in time, maybe the end of the period. We are going to estimate our bad debt expense, right? We don't wait until the person unequivocally conveys to us they're not going to pay. We take the expense more closer to the date of sale at a certain point of time, based on an estimate, not actual knowledge that they're not going to pay us. Later on, right, when they don't actually pay us, we write off the account, right? So step 0, 1, 2. We'll talk about what each of these mean, but if you just keep in your mind for right now, you have the direct write-off method, you wait until they don't tell you, or you wait until they won't pay, debit, bad debt expense, credit, account receivable. That's not GAAP. We don't follow that. We instead use the allowance method where we record the bad debt expense, step 1, estimate it, and then later on, when they don't pay us, we kind of, in a way, remove that estimate and reduce the account receivable. Okay, so the allowance method, right, the idea here, as I've indicated, company's not going to actually know how many customers aren't going to pay their debt, what their bad debt expense will be, right? If you knew that, you wouldn't sell it to them in the first place. We're not, like prognosticators here. We don't know the future. However, we do know that, given the reality of the world we live in, that some of our customers aren't going to pay their receivables. So the best we can do with this, and especially to try to match, right, our revenues with our expenses under that matching principle, it's better that we take the estimate, or we take bad debt expense more upfront before the customer conveys to us they're not going to pay, and that we base it on an estimate because it better matches the reality of the situation, right? It's like accrual accounting better matches the reality or the health of the company. In any event, right, what we do here under the allowance method is that we make an estimate of bad debt expense. And essentially, right, you're going to debit the bad debt expense, which is going to represent a contra account for the accounts receivable. It's basically what we don't think we're going to collect. And then we're going to credit the allowance for doubtful accounts, right? It's this like ADA account over here. Right, so that's what this journal entry in step 1 says. We estimate, this amount of account receivable are going to be uncollectible. Now, when you report on your balance sheet, right, your accounts receivable, you're going to report them net, right? Net, remember you subtract one thing from another, of the allowance for doubtful accounts, right? So here's the idea, right? You'd see on the balance sheet $100 accounts receivable, net of a $50 allowance for doubtful accounts. The idea there is like we truly have 150 kind of gross accounts receivable, but once we back out this 50 for the allowance for doubtful accounts, we show it there at 100. Right, so that's the idea. If you're looking at a balance sheet, it's going to be shown net of that amount. It's kind of like net book value, right, where we have the cost minus the accumulated depreciation. It's like that with accounts receivable. It's like we have our gross amount minus the allowance for doubtful accounts gets us our net accounts receivable. So this is just showing you, what it might look like. Hey, we have trade in the normal course of business, accounts receivable, net after we back out that allowance for doubtful of accounts of, right, like 405. Okay, so we talked a little bit about the theory of the allowance method, right? We said it's based on an estimate. We said that it better matches like the reality of what's going on. How do we actually effectuate this, right? So there's going to be a step one where we have to make the journal entry for the bad debt expense and calculate it, right? So it's like any journal entry, you need to know the accounts that go in there plus the numbers that go with the accounts. That's step one. And then step two is on the back end, how do we kind of reconcile this estimate in step one when we actually know that a customer isn't going to pay, right? In that way, we have to true up our estimate to reflect the actual, right? So that's going to be step two, write off the accounts that are deemed uncollectible. So step one, take the bad debt expense, do this journal entry. The numbers you're going to put in here depend on what method you want to use. Step two, right? A customer conveys to us that they're not going to pay. We then write off the uncollectible account, debit the allowance for doubtful accounts, credit the receivable. So step one, tee it up. Step two, get rid of it, get rid of the receivable. For purposes of step one, in this journal entry, the numbers we put in are an estimate. And there's two ways you could calculate it. One is going to be based off this percentage of credit sales method. One is going to be an aging of receivables method. Now, in this framework for the allowance for doubtful accounts, it's pretty important that you know the T account, right? What you would see on the general ledger for the accounts receivable and the allowance for doubtful accounts. Right, so I would highly suggest that you memorize these. It's on the class notes. But your accounts receivable, right, it's going to be your beginning plus your sales on account, right, where you debit account receivable, right? That's why it's on the left side, debit. Any collections you have where people pay you back, right, or pay on the account, that journal entry minus any write-offs gets you your ending, right? So you're going to want to pause this. Make sure you write that in the class notes, the T account. Likewise, you're going to need to know the T account for the allowance for doubtful accounts. Right, so this is a contra asset account. It offsets account receivable. Accordingly, it's going to have a credit beginning balance. Contra the opposite. So asset has a debit balance. Contra has a credit. It's like Bizarro, right? We have our beginning balance plus any bad debt expense, right? That's step one, journal entry increases the allowance. But the step two journal entry, we get rid of it in our write-offs. That's going to get you your ending balance. So take a minute. You might want to pause. Make sure you write this in the class notes. Okay, so we talked about the framework. Now let's look more specifically at step one, right? Here we are at the end of the period, right? Step 0, we sold it, the accounts. Here we are at the end of the period. We have to make an AJE for bad debt expense. The journal entry, debit bad debt expense, credit allowance for doubtful accounts. And with this, right, we have an increase in an expense, which decreases our net income. We have a decrease in assets, which decreases our total assets. But how do we know which journal or what numbers to put in step 1? Right? We know the journal entry. What numbers go in there? Right? Well, we have 2 ways we can figure out the numbers that go in there, A and B. Right? The percentage of credit sales or the aging of receivables. So if we would look at A, right, to help us figure out what numbers to go in that step 1 journal entry. The idea with this is we are going to make our estimate under the assumption that the best predictor of future behavior is past behavior. In other words, if historically, for example, 5% of our credit sales have resulted in bad debt expense, then in the current year, if we had $500,000 in credit sales, we just multiply it by the 5%. Right, that would give us our estimate, right? Historically, we don't collect 5%, sold 500,000, 5% of that is 25,000. That's the number we would put in the step 1 journal entry. Now, kind of showing this in relation to the T account, right, for the allowance for doubtful accounts, you'll have your beginning balance plus your bad debt expense minus your write-off gives you your ending. So method A gives you, this guy right here. The other 2, you'll have to solve for the ending balance, right? And you'll see this, we've seen this in accounting before, right? Traditionally, a lot of times what they'll do, if there's variables 1, 2, 3, and 4, they'll give you 3 of them and you have to solve for the ending. It could be these 3 you solve. It could be these 3 you solve, right? It could be any of the 3. But here specifically, if we use this method A, right, what we're going to have to solve for is the ending because we'll be given these 3, we have to solve for the ending. Method B in distinction is another way we can figure out what numbers to put in the step 1 journal entry. And the idea with this is, well, like 5% is a good amount. It's based on past precedent. Really, how accurate is that, right? Is there a way we could be more specific? So the theory here with the aging accounts receivable, the premise they're going on is the longer a receivable has been outstanding, the less likely a business is going to be able to collect that receivable, right? It's kind of like a breakup. If you've ever had a breakup, right? The longer you guys have no contact and you aren't texting or communicating, the more likely you're not going to get back together, right? It's like in the beginning, the first breakup doesn't stick. Then you have this window where maybe you could get back together. But the longer the time that passes, the breakup has happened. It's a true breakup. Same idea here, right? If we have accounts receivable, a bunch of them, we're going to look at all our accounts receivable and kind of put them into buckets. How long have they been outstanding, right? Since we made the sale and the people haven't paid. Is it 0 to 30, 31 to 60, 90 days? Put them in the buckets. Then we assign a percentage to those buckets, right? The longer they've been outstanding, right, the higher the percentage is going to be. Cross multiply, right, 100 times 1, 50 times 3. Add them together, foot them, right? That's going to give you 65,000 for your ending allowance for doubtful accounts. Right, so here's the idea. If you use method B, you're going to be solving, or you're going to be getting the ending balance here. You'll have the beginning and the write-offs, and you need to solve for the bad debt expense adjustment. Right, so method A, solve for the ending. You are actually calculating bad debt. Method B, solve for bad debt. You're actually calculating the ending. Right, and that's what this slide right here is showing to you what's going on. Again, we're in step 1. We're making an estimate of bad debt expense. debit bad debt expense, credit allowance for doubtful accounts. Which method you use, A or B, tells you the numbers to put in that journal entry. Okay, we just did step 1. Now, how do we deal with step 2? Right? Time has passed. We now know that a customer is not going to pay us. Right? Maybe it's next period, the year after. But at a certain point, it will be conveyed to us. We will be aware. We can be reasonably certain that we're not going to collect an account. Right? In this way, in step 2, we would just do debit allowance for doubtful accounts, credit the receivable, right? So we get rid of the receivable and we get rid of the allowance that we teed up in step 1. Now, if you look at this, right, this journal entry, it really doesn't have much of an effect in the sense that it doesn't impact the income statement, right? There's no revenue or expense counts here. And in this way, because we have plus asset, minus asset, it's not going to have any real effect on total assets or accounts receivable. All of it's going to cancel each other out. Right, so step 1 is kind of the more important step in the sense that's when the impact is really going to be felt on the financial statements because we have that expense that hits the net income and we're going to reduce our accounts receivable. Here, step 2, it's kind of like a wash, right? Nothing really comes of this other than getting the receivable off the balance sheet. Not hitting the P&L, not really affecting total assets. So this is showing you, right, step 1 and step 2. So step 0, we sell on account. Here we are at the end of the year. Got to do the AJE for step 1. Debit bad debt expense, credit allowance. 2 methods, A and B, to help give us the numbers. A year passes, maybe 2 years. We become aware a customer isn't going to pay, debit the allowance, get rid of the receivable, right? Step 1, step 2, tee up the allowance, get rid of the allowance, take the expense, get rid of the receivable. All right, let's talk a little bit about effective management of accounts receivable, right? You want to make sure as a business that you're minimizing how much bad debt expense you take. So to do this, right, a couple things. First thing is you want to screen your customers that you sell to, right? And the analogy here is kind of like a landlord, right? If you ever want to be a landlord, the absolute most important thing you can do is screen your tenants and be picky about your tenants, relying on their objective measures such as their FICO score. Right? You don't want to rent to somebody who's not going to pay. Now, if you don't have a good FICO score, it doesn't mean you're a bad person, right? But if somebody has a business and they're trying to, rent a place or sell goods, they want to make sure that they get paid, right? It's not a charity that they're running; it's a business. So, for selling your goods on account, one thing you can do to minimize bad debt expense is screen your customers. Only do business with people who are going to pay you or have a strong likelihood who are going to pay you back. Another thing you can do is age those receivables, like in method B, and reach out to customers who have overdue payments. Hey, you haven't been paying, right? You need to pay. It's kind of like a debt collector almost. And then likewise, right? You want to reward collection of accounts, right? If people pay on time, those are good customers. You want to keep working with them. It's kind of like if you're a landlord, right? If you have a tenant you really like, hey, reward those tenants. They're paying on time. They're low maintenance. Don't raise their rent, right? You want to reward them. So it's kind of like screen, get rid of the negative tenants who aren't going to pay. Then, reach out to ones who you have rented to or people you've made sales to help collect, right, for overdue payments. And then reward the ones who are paying, your customers who are paying. 3 different paths there. Now, while we're on the balance sheet, let's move over a little bit and talk about cash, right? So with cash, when they're talking about this in accounting, they really mean cash in cash equivalents, right? So when you see cash on the balance sheet, kind of implicit in that is the green stuff, right? Like what you'd see in the bank account or things like that. But it's also other like highly liquid short-term investments. So things like CDs, money market funds, all of those, if it has a short maturity, like within 3 months, like very quickly you could liquefy these things. That's part of cash. Now, cash, right, as a business, if you're running a business, you really have to protect it because it's subject to things like theft, fraud, loss, right? Maybe your employees are like skimming off the top or something, right? You really want to prevent these things. So likewise, the other thing with cash that's important is you have to have the appropriate amount, right? You need to have enough to run the business. You need to be able to pay off your liabilities as they come due. Also have to have an emergency fund, right? It's just like personal financial planning. You have to be able to have the right amount that you can live your life, but also be fiscally responsible. Now, one thing that's important in accounting is this thing called an internal control, right? And the idea here is an internal control is a mechanism that helps safeguard or protect your assets. And it really helps controls with the efficiency and the effectiveness of your company, its operation. It also helps with compliance with laws, right? Because post-Enron, there were a lot of rules about internal controls over the financial reporting process, right? We need to safeguard this. But with cash, you're going to want to have a lot of controls around them, like policies, procedures to help protect them. And some of the things you can do here is like separation of jobs. So like, you can have one job where a person receives cash in the company and another where they pay the cash out, right? So one person, their job, they're collecting the cash, and the other person's job disperses the cash. Same for like the people who do the accounting, right? The accounting people have one be doing the inflows and the other be doing the outflows. Likewise, separation of handling of cash in the accounting function. The idea here is with cash, you really have to be careful and not give one person too much ability. So for example, right, if you've ever seen a drive-through, like a fast food drive-through, did you ever notice they have like two windows there, right? One is where you pay with the cash and the other is you get the goods. Part of that is efficiency, right? If you're just like idly sitting there, the idea is, hey, let's have you check out now. It'll save us some time. Also, part of that is to protect, the cash and the inflow, right? If we give the person the same ability to give the goods and the cash, if one person has too much, then they can start, kind of messing with it a little bit. Maybe, giving people goods for free and not collecting the cash, or shortchanging people and not giving them enough goods. The idea is you really need to separate cash, the process, the procedures, and the product as much as you can in the business. It's more of like an upper level accounting class, like fraud or auditing, but it's an interesting area of accounting. Some other things you can do are like daily deposits, right? Go to the bank daily, drop off the cash from the business. Have separate approval processes for purchases and payments. Use things like pre-numbered checks. The big one here is bank reconciliations, right? You can require these. That's a good internal control for reporting cash. So here's the idea with it, right? With a bank statement, or a bank reconciliation. You're going to have your cash balance from the books, and you're going to have a bank statement that comes at the end of the month, right? So if you've ever had a bank statement, you get one once a month. Used to be like in mail. Anymore they always want you to sign up for these like electronic billing and statements. But the idea with it is, if you see your bank statement, it's going to look something like this. You're going to have a beginning balance. You're going to have every time you got money and you spent money, right? And then it'll take you down to your ending balance. Now, a bank reconciliation essentially says this, right? It's a control over cash. If I came to you and you were the accountant at a business, and I said, can I see your bank statement for the month of January? Okay, here you go. I'm looking at your ending balance on the bank statement. Looks like you have $1,000 there. Okay, at the end of January. That's great. Hey, by the way, can I please see your general ledger in the T account for the cash balance? Oh, wait a minute. Why are you showing $800 there? Right? That's the idea of a bank reconciliation. You are going to have a difference at the end of the month for what you have on your books for cash, for ending cash, versus what the bank statement says. Now, the idea with a reconciliation is we're really trying to explain away these differences. In other words, if I came to you and I said this and say, look, did you screw up? Why are these different? How you would respond to me is you would say, no, I didn't screw up. What's going on here is we need to perform a reconciliation, a bank recon. And because we as the business have one point of view and are aware and see certain things, and the bank as a separate entity has a separate point of view, we're going to account in a little bit of a different way for what we're eligible to see and do. Once we get our two documents, the bank statement with our books and records, we can see where these differences arise, explain them, and then correct them so that both have an ending balance that matches. So some of these, right? The first one would be an outstanding check, right? So here's the idea at the end of the day, what it's going to look like, right? So maybe you have $900 here. And $1,100 here. Right? They're different. So what you have on your books versus what the bank says, and I say, hey, there's a problem. What's going on here? The first thing how you would explain it is, well, maybe, hey, there were some outstanding checks. Right? An outstanding check is this. You write a check to a third party, right? You give it to somebody for their wedding, right? $100. And what you've done here, right, you've given it to them, but that money doesn't actually come out of your checking account until the person cashes the check, right? So it's an outstanding check. Until they cash it, right, it's kind of floating out there. And what's going on, you're aware of this, right? So you've subtracted that $100 from your books, from cash, but the bank isn't aware of it, right? The person at the wedding who got it, they're on their honeymoon, right? They haven't cashed their checks yet. Although most people, right, before the wedding ends, they're like trying to get to that cash box to figure out how much they got to pay off, their $40,000, $50,000 wedding. In any event, right, how you would reconcile or resolve this difference is because we've subtracted that $100 already on our books, we know that we wrote that, but the bank hasn't subtracted it yet on the bank statement. We would subtract the amount from the bank statement, right, over here, where we at outstanding checks, right, subtracted. The next one would be deposits in transit, right? So here's the idea, right? Checks received and deposited by a company, not yet recorded by a bank. So when you get a check, right, and you were to deposit this thing, it doesn't automatically hit your account, right? It might take a day or two to clear. And if during that day or two, the bank issues its end of the month report for you, it wouldn't have accounted for that because it hasn't cleared yet. So the idea here is you have money, you got a check, you added it to your books, $50, right? But the bank hasn't added it on their end yet because it hasn't cleared. So how you correct this, right? Because you've added it to the books, but the bank hasn't, you can correct it by adding it to the bank. Third one here, right? Bank service charges. So these are like fees, right, that the bank charges you. So, at some point you've probably opened up a bill or a bank statement and you said, oh my gosh, what is this fee or what is this charge? right? So the idea here is maybe you have an overdraft fee and you didn't know about it. When the bank, right, they take that out of your bank account automatically. They've subtracted it from your cash balance there. However, you don't know about this, right, until you get the bank statement. So what has happened is it was subtracted from the bank's point of view, but from your point of view, you haven't subtracted it yet. To correct that, how to resolve these differences, you would subtract it from your books. Bank has subtracted it, you haven't. To correct it, you need to subtract it. Fourth one here, NSF checks. So that means non-sufficient funds checks. It's basically a bad check, right? If somebody writes you a check where they don't have money in their account for it to be cashed. So if you've ever seen the show Seinfeld, there's an episode where Jerry, right, the main character, he gets a check for his birthday from his grandma. And he just forgets about it. He puts it in a drawer and it's like sitting there for 20 years. One day he's like cleaning his room and he finds this check. Well, in any event, his grandma, she thought that he cashed it. She totally forgot about this check. And he goes to cash it and it ends up being a bad check, right? Grandma at this point in time, she had like a really low balance in that account. She forgot about the account. So she has a bad check she's written Jerry, and kind of like the comedy of it is they start like calling the grandma, and because it's a crime to write a bad check. But in any event, what's going on here, right? If you think about that situation, when Jerry got the check from his grandma, he included it in the income. However, right, when the bank got the check, they denied it, right? They didn't include it because it was a bad check. Accordingly, because it was not included on the bank, but we had included it to books, the way we resolve that is we subtract it from our books, right? Our books are overstated. They're too big. They include grandma's check when grandma's check is a bad check. If it's a bad check, you got to get rid of it. You got to subtract it out from our books. Next one here is interest. Right? So this is interest paid by the bank to the company. You open up the bank statement. While you know you earn interest, you don't know the exact amount until you see the bank statement. So what's going on here is the bank has already added it, but you haven't added it to your books and records yet. In this way, because the bank has included it, but you haven't, you have to include it to resolve the difference. Add it to your books. 6-year errors, this can go either way, depends on the facts and circumstances. But if one side screws up, it can affect the other side. Right, so this is just an example here of what's going on, right? Maybe we have 900 and 1100. I don't know, let's say that there was $50 interest paid by the bank, 25 in non-sufficient funds, right? So we're going to be at 925 in ending balance. 900 plus 50 minus 25 gets you there. This guy, right, there was 1100. Maybe there was 200 in outstanding checks. $25 deposit in transit, that's going to get you $925, right? We start out different. I come to you, hey, what's going on? Why are these different? You reconcile them, explain the differences through these items, right? And that's why I have this ink here, right? INC for books. Think the DOB here for cash, the bank statement. So get this back to the X's just to get that where it was. This is another example of it, right? You start out different, you make the adjustments, you end up the same. And every time you make these adjustments for the books, right, you're increasing or decreasing cash, you got to do the associated journal entry for it, right? Like debit cash, credit cash. Finally here, a couple different ratios, right? We have the receivables turnover ratio. This is going to be how many times average trade receivables are collected during the period. Basically, the higher the ratio, the faster the collection of receivables. So you're going to have your net sales, right? Your gross sales minus that card acronym right here. And you're going to have your average, which means your beginning plus your ending divided by 2, net trade accounts receivable. So you're going to look at your trade accounts receivable and then net them for that allowance of a doubtful of accounts. Second one here is the average collection period, right? This is the average time it takes a business to collect on its account receivable. So this is basically 365 over the receivables turnover, right? So you got to do this one first. So 365, like this one, if I tested you on this equation, it's like a 3-in-1 because you got to know this guy, which means you got to know this guy, which means you got to know this guy. In any event, right, if this was like 35 days or something, right, 365 ended up being 35 days, what this is showing is it says, on average, when we make a sale on account, it takes us 35 days to collect it, right, to get the cash. That's what they mean here by average collection period. So with this, right, you can go through, look at the lecture again. This is one of those you might have to hear multiple times, see multiple times. But with that, we'll end the lecture here.